Welcome to everyone to today's session, where we're going to be discussing 7 common myths about DORA compliance. My name's Nicola Cowburn. I'm a RegTech advisor at GEOM. So GEOM's a technology provider that has focused 100% on operational resilience, delivering technology solutions to more than 100 financial institutions around the globe for more than 12 years. So our panel today includes members of GEOM's leadership team, as well as members of our expert advisory board. Each of us speaks every day with firms that fall within scope of DORA, and we often hear views that are commonly shared, but which in reality appear to be dangerous myths that are often perpetuated through misunderstanding or misinformation. Not only are those myths jeopardising these firms' ability to hit the January 2025 DORA compliance deadline, but they also have the potential to cause longer lasting harm. So today, what we're going to do is share each of these myths with you, explain the risks of believing the myths, and explain the reality. And as we go through the discussion, we'll also aim to offer some best practice advice on the action you should be taking now. We have an ebook that summarises the myths. So throughout the discussion, we're going to display a QR code that you can use to download the ebook. It's also available on our website, which is www.dora360.ai. So I'm going to move swiftly on now and introduce our panel. So what I'm going to ask our panelists to do is introduce themselves. So I'm going to start with Dr. Jimmi Hinchliffe.
Thanks very much, Nicola. So my name's Jimmi Hinchliffe, 25 years in operational risk and regulation, starting at the UK Financial Services Authority, where I held a number of roles, including as an operational risk policy expert in the early days of Basel II. I then moved into supervision, supervising major international banking groups and investment banks, and then finished up at the regulator, where I spent about 10 years leading the Basel II implementation team. Then joined MUFG, the biggest Japanese bank, and headed up a department within the regional compliance division called Policy, Risk and Regulatory Affairs. And this was obviously an interesting time, given that we had this post-GFC huge regulatory tsunami of changes, and that was with my team to really manage. In 2016, I decided to set up my own consulting firm, and I've been doing consulting mainly in the operational risk, resilience, and regulatory spaces since then. And particularly in the last 3 or 4 years, been working very closely with Andrew and another colleague, David Goodyear, as part of Jade, and then for the last few years with GEOM. And very happy to be here today. Thank you very much.
Thank you. Now I'm going to move to Bhavana Mallesh.
Yeah, hi. Thank you, Nicola. I'm the Chief Technology Officer and co-founder at GEOM. I have over 20 plus years working with financial services industries. In the last decade, I've largely been involved in the RegTech space, building software, working with customers, helping them with several different regulations, being part of the Sarbanes-Oxley Act implementation that happened at BarCap a decade back. Now I'm excited about having a solution to cater to the DORA regulation and looking forward to working with financial institutions who are looking to get compliant with DORA and other UK operational resilience regulations. Thank you.
Fantastic, thank you. And now on to Andrew Sheen.
Thanks, Nicola. I spent 10 years at the Financial Services Authority, which then morphed into the Prudential Regulation Authority. When I left those bodies, I'd been leading up a team of risk specialists who would go and look at firms' operational risk and governance frameworks for supervisors. I think the highlight of my period at the bank, at the regulator, other than, of course, the pleasure of working with Jimmi, was the time I spent working on the Basel Committee's Operational Risk Working Group. When I left the regulator, I had a spell at HSBC looking at how they were using their op risk framework. And then I finished my career at Credit Suisse, where I sat between the firm's operational risk function and the 2 regulators that reviewed them. When I retired in 2020, I set up a consultancy to provide consultancy and services and training in op risk, operational resilience, third-party risk management. And that's how I got here today. Thank you, Nicola.
Great. And last but not least is Antony Bream.
Thank you, Nicola. Hello, everybody. Antony Bream. So I've spent 15 years working with financial institutions to help them bridge the gap between what they're trying to achieve with operational resilience or compliance initiatives and the technology enablers that can help them accelerate and embed and demonstrate to regulators that they are actually embedding an operational resilience mindset across their organisation. So I've worked with Bhavana in the past on a number of projects for Sarbanes-Oxley, and I have also worked with other companies in areas such as FATCA, Solvency II, and more currently DORA. Typical issues that we tend to find is that firms are reaching out to their traditional tools, which are generally Visio, Excel, existing systems that aren't quite fit for purpose for the breadth and the depth that the regulators are now expecting to see for operational resilience. So very pleased to be working with GEOM, and we've built a very, very strong and powerful solution with DORA 360, which can also accommodate other operational resilience acts across the world. And looking forward to exploring a few of the myths and coming up with some benefits from getting an operational resilience mindset embedded in your organisation.
Great, thank you. So we'll press on straight into the 7 common myths about DORA compliance. So starting with you, Jimmy, myth number 1 is we coped with COVID, so job done on resilience.
Indeed, and something that we were hearing, particularly in that year or so after the COVID experience was over. I think probably just to step back a little bit, so post the GFC, obviously international regulators started focusing on financial resilience, more capital, more liquidity, strategic resilience. And then they came on later to this thing that became known as operational resilience, obviously broader than just DORA. So within the BCBS principles and in the UK, you have this idea of operational resilience, and then DORA focuses very much on that ICT-based side of resilience. But we had the consultations within the UK on their proposals driven by these really egregious IT failures in impacting a number of banks. Probably everyone's heard of the RBS one in 2012 and then the TSB one in 2018, which was so bad they actually led to a parliamentary inquiry into IT systems within banking and looking at the fragility of systems, the apparent fragility of systems. And UK regulators then consulted on their proposals around operational resilience. In the middle of while they were consulting, you had then the COVID-19 pandemic struck, and we often talk about this at conferences and at the time, and some people would talk about this as being a black swan incident. The COVID and the pandemic was a black swan. I think this is a balderdash. Clearly pandemics have been with us throughout human history. Most nations, supranationals, most firms had pandemics well within their risk registers. There was an anticipation that this would happen. Even within recent memory, we had like the avian flu and what have you. So this was certainly something that wasn't a black swan. On the other hand, I think in many ways the response from many countries could be considered actually a black swan event. The whole thing about locking down people, locking down businesses, requiring businesses basically to shift overnight to remote, 100% pretty much remote working, was something that no one, I think, anticipated, particularly in the West, and it certainly wasn't in any of the pandemic plans. I think what you saw, because most of the bigger firms, most of the banks managed to cope reasonably smoothly with the COVID-19 disruption caused by the policy response, that you did start to see an element of complacency. And certainly we picked this up, and we're certainly aware that regulators picked this up as well, that a number of banks were saying, well, we managed to deal with a disruption that was actually probably beyond plausible. If you talk to people before the COVID-19 lockdowns and said, is it plausible that you will have a lockdown of the nation impacting for almost 2 years and having firms having to move their businesses to remote, people would have said, that's cloud cuckoo. that is not a plausible scenario that we would need to manage. Yet actually they did cope with it reasonably well. They shifted businesses to remote working. Even those banks who didn't necessarily have a culture of remote working managed to, go out and buy laptops in the high street and quickly set up so that their people could work from home, and managed to perform, a reasonable continuity of business, of important business services from remote working. So it's perhaps understandable in a sense that some organizations took this view that, we've handled COVID, therefore we're fine on resilience. And you did see this element of complacency. I think that is a dangerous myth and a dangerous position to take for at least a couple of reasons. And these are reasons that are, I think, specific to the type of disruption that was driven by COVID-19. I think firstly, this was a slow burn event. So banks within the UK, within Europe, were able to see the disruption emerging within China, within Asia, and they had time, they had months to prepare. So there was an anticipation, I think, this could be bad. They'd seen the policy responses that had been taken by other governments, so there may well need to be more remote working. I think a lot of firms then were able to put in place plans for remote working and to move into a remote working type of a situation pretty quickly, but within a reasonable time frame. I think the other the other interesting factor that makes things different with COVID-19 is that, of course, it impacted everyone. Literally, it was a global impacting event. So whereas a more common type of disruption would impact maybe just a firm, or maybe just a small number of firms, this impacted everyone. And I think that had the effect that people were much more willing to give tolerance to a disruption. I'm sure I certainly experienced it. I'm sure everyone on this webinar would have experienced trying to phone up their bank and been held in a call center queue for much longer than you would normally tolerate. So normally you'd phone and, if it was like 10-minute, 15-minute wait, you'd be not very happy. Typically you'd have a voicemail to greet you when you phone saying, because of COVID, because of remote working, waiting times are much longer than usual. But people, in general terms, were willing to tolerate that kind of reduced level of a service. And equally in other factors, when they needed to do something, for instance, with their bank, and they were told that, because of people not being in the office, it's not something that we can do as quickly as we normally would. Again, people were willing to tolerate that. So I think these two factors, number one, it was a slow burn. Number two, it impacted everyone, are reasons why firms shouldn't take COVID-19 and a relatively smooth experience of managing COVID-19 as a reason not to take operational resilience and DORA seriously. And certainly we would advocate firms absolutely taking these seriously. Regulators in the UK gave a very long implementation timeline. If you think about the CP back in 2020, the final rules 2021, it's next year, end of March 2025, the deadline. That's a very long implementation window. And this isn't because regulators suddenly became generous. It's because there's an anticipation, and we've seen this before with the IT failures, that a lot of firms are going to have to take actions to address vulnerabilities in their resilience, which could be putting in place new systems, upgrading systems, replacing critical third parties. So it's going to take time. So you really do need to focus on addressing these vulnerabilities, taking actions, and ensuring that you're compliant by the deadline.
Fantastic, thank you. What a way to start, Jimmy. But I think that sets the scene for what we're going to hear coming forwards. I'm going to move on to the next myth now. So myth number 2, I'll go to Bhavana for this one. So DORA is a cybersecurity regulation, so IT and info security have it covered.
So right, DORA is a cybersecurity regulation, so IT and info security have it covered. While cybersecurity is a critical component, the regulation actually extends quite beyond. Any firm which is believing this myth, that DORA is a cybersecurity regulation, risk late and incomplete compliance. What DORA and other operational resilience regulations mandate is a very holistic approach. They are looking for firms to prevent, detect, and respond to a wide array of operational disruptions. These could be disruptions like system downtimes, human errors, software vulnerabilities, and third party dependencies, to name a few. I think this myth exists just because of the prominence that has been given to high profile data breaches that have happened because of cyber attacks. But if you really see, the regulation has a broader goal. It is calling for firms to establish a unified framework for risks and resilience. So it is all about proactive risk management and having a prepared response in place to react in case there are disruptions. While it is true that frameworks like ITIL and ISO 27001 offer a lot of valuable, guidance for these firms, but they are not, broad enough, and they're not in a position to just if you comply with them, you won't fulfill the DORA regulations. So we clearly note that DORA is not simply a cybersec regulation to be managed by IT and InfoSec departments alone. It is quite wide. Now let's look at the myths the risks in believing this myth. What about the recent CrowdStrike incident? Was it a cyber attack? Absolutely not. It was a routine software update, and that caused millions of Microsoft devices to be shut down, impacting multiple sectors globally. It costed billions of dollars of damage or losses to businesses. Let's look at another incident. Dr. Jimmy just mentioned the TSP incident of the data migration and the core banking upgrade that happened. It was not a cyber attack, and it was not really IT technical failure alone. It was operational mismanagement, and it caused such serious repercussions. So this is very clearly much broader, when we talk about resilience. So looking at DORA compliance as just an IT task or an InfoSec task can lead to a lot of accountability issues within the organization. And if the firms continue to believe this, they're going to lose valuable time, the time required to make a cultural shift, a time required for everybody to prepare to become compliant. And if you have this narrow view, another thing that can happen is there may be resistance that comes in with the staff. When suddenly you have to rise up and start working towards building, your resilience initiatives. So these are the risks of believing in this myth. Now, if you look at what the reality is, at its core, DORA is multifaceted. It is quite prescriptive. It is structured around the 5 pillars, which can guide the organization in enhancing their digital resilience. So first up is the ICT risk management. That is the foundational element, which is requiring for the firms to establish operational frameworks for identifying, assessing, and mitigating risks across all their information and communication technology systems. And it's not just about having a plan, it is calling for organizations to conduct regular risk assessments, ensuring that controls are effective, ensuring that new vulnerabilities are getting detected, with its evolving business dynamic, right? So this is the first pillar. Now, if you look at the second one, it's about incident reporting. DORA very comprehensively mandates a very standardized approach to how incidents are recorded, reported, guidelines on what types of incidents must be communicated, the time frame for communicating it, what should be the ongoing notifications that should be provided, to show how you're mitigating the incident, and so on. So this is the second pillar. Now coming to the third pillar, which is all about resilience testing. Firms now need to show proof of regular testing of critical IT resources. These are the IT resources which underpin the critical operations, the critical business processes that the organization is servicing. This means you will need to, identify proactively whatever weaknesses you have in your digital infrastructure. So DORA is calling for a very proactive approach. And when you look at resilience testing, it is cutting across departments. It's not just relegated to IT or InfoSec. Coming to the fourth pillar, it's about third-party risk management. In today's interconnected world, financial institutions rely heavily on third-party service providers. So there is a need for comprehensive evaluation on your third-party service providers, right from looking at contracts, looking at doing a very thorough due diligence, looking at the senior management stability at the service provider, what kind of digital reputation they have. Okay, and this is something that needs to be done on a continual basis. You will need to monitor the performance of your third-party providers on a continual basis to stay resilient. Last but not the least, we have the fifth pillar, which is all about governance. And DORA is placing a significant emphasis on the involvement of senior management to make sure that governance structures are in place so that they have the right policies on how they are managing their critical operations. So essentially, it is if a firm aligns to the five pillars, they will significantly enhance their preparedness for operational disruption. So I would like to say that organizations should look at DORA and other operational resilience regulations like the UK operational resilience or Australia's APRA CPS 230 as an opportunity to review how they deliver their critical operations and ensure that they have the necessary strategies in place to deliver the promise that they have made to the customer.
Yeah, that's really interesting. And I think, as we go through the other myths, there are some threads in your myth and what you just talked about that will carry through some of the other myths as well. So I'm going to move on in the interest of time to myth number 3. So myth number 3 will direct to Andrew. This is one that always amuses us, isn't it, Andrew? So myth number 3, the DORA deadline may change, and even then we're under the regulator's radar.
Thank you, Nicola. Yes, it amuses us, but I think it's rather sad when you hear firms expound this myth. And it always goes hand in hand with firms that have failed to comply with the respective regulatory requirement. And I can't sit here and say that regulators never delay regulations. We've just seen recently in the UK that the PRA delayed the implementation date of the Basel 3.1 standards. And that's been delayed to provide a 4-year transitional period to ensure full implementation. But the EU regulators have already built in at least a 4-year implementation period so firms can prepare for DORA. And the vast majority of firms have devoted considerable expense and resources to ensuring they're compliant. So we can't expect the EU Commission, the EU Parliament, the 3 European supervisory authorities to effectively reward these deadline day deniers by putting back the DORA deadline. And in doing so, they would punish the DORA adapters. And that's simply not going to happen. I think firms are deluding themselves. There's another category of firms that we've captured in this particular myth, and they're the firms that I call low flyers. They just assume that they can fly under the regulator's radar, so the failure to implement DORA will go unnoticed. That's nonsense. DORA lists the entities captured by the regulation, and many of those are small firms. There is an exception for very small firms, but that means less than 10 employees and an annual turnover or balance sheet under 2 million euros, so very small, and also intermediaries with less than 250 employees and a turnover under euro 50 million or a balance sheet under euro 43 million. So if you're not in that very small group and you somehow think that you can fly low under the regulatory radar, I think you're either being very courageous or foolhardy, and I would favour the latter. I think the boards and senior management of both the deniers and low flyers are being very foolhardy. DORA's here to stay, and it will become effective on schedule. Clearly, regulators will respond to all institutions that fail to achieve the desired level of compliance within the deadline. And if you don't want to be on the receiving end of regulators' disapproval, and you experience an operational disruption after the implementation date, that's going to highlight your failure to comply with DORA and put you in a very difficult position with the regulators. So there is no scope for firms to claim they had insufficient time to prepare. And there's a real risk in adopting this particular myth because in response, regulators could require you to cease the conduct that's breached DORA and ensure it's not repeated. They could require the temporary or permanent cessation of any practice or conduct considered to be contrary to DORA's provisions and prevent repetition of that practice and conduct. They could impose any type of measure, and that can include financial penalties, to ensure that entities continue to comply with DORA. They could identify the perpetrator publicly and reveal the nature of the breach, causing significant reputational damage to a firm. They can impose enforcement fines on critical ICT third-party service providers as well. So, in conclusion, DORA, it's inescapable. DORA will apply from the 17th of January 2025, and laggards and low flyers that are in scope must ensure they're compliant by that date. The sooner these firms accept that the DORA deadline won't move or they're in scope and therefore have to comply, the sooner they can get started. I do think it's still possible for firms wishing to avoid penalties as a result of their non-compliance. I think there's still time to do so, albeit there's only 4 or 5 months. And so it's important that firms start to address the deficiencies now. The reality, I think, is twofold. Most laggards will fail to achieve compliance in time without a technology-enabled approach designed to address the nuances of DORA, combined with the specialist knowledge of regulatory experts who can help interpret DORA requirements, formulate effective strategies, and implement according to best practice. The sheer volume of work that's involved in demonstrating DORA compliance, the heavy lifting required, and the expertise needed to conduct the preparatory steps of doing a gap analysis against the new rules, identifying policies and procedures that need updating, analysing ICT service provider contracts. This is just too vast a task to undertake using traditional approaches, spreadsheets, for example. I'll be talking about that in a minute, or outdated GRC systems. And the skill sets needed to accelerate implementation are rarely present in-house. The good news is that technology, and especially generative AI, is enabling firms to conduct the analysis required in a much faster timeline, much cheaper and more completely. Granting you, if you're a denier or a low flyer, I think you just have enough time to work with experts to be able to evidence DORA compliance on time. But, you know, as John Wayne once said, we're burning daylight, and we certainly are.
That's great. And sticking with that theme of best practice, we're going to move on to myth number 4, which you're also going to talk about, and Andrew, which is so myth 4: we can run our operational resilience controls off a spreadsheet. That's not best practice, I would imagine.
Those that know me, Nicola, will have heard me rant about this issue on numerous occasions. I've long been a critic of firms that seek to manage their risk exposures, their compliance, their operational resilience using spreadsheets. To put it bluntly, these firms are using valuable resources to manage data when they should be using those resources to manage risk and compliance. I've seen it in so many firms where this manual processing and spreadsheets simply uses up the time that should be used in order to manage risk and compliance. And that's nowhere is that more true than when we look at DORA and simply the volumes of data needed to manage both DORA compliance and also demonstrate this task is being completed effectively. One of my other mantras is absence of evidence is evidence of absence. If you can't demonstrate what you're doing, then the regulators have to assume that you're not doing anything. It's the only conclusion they can reach. And so you need a system to enable you to demonstrate that the task is being completed and being completed both robustly and effectively. So in addition, by failing to introduce the changes necessary for the robust and effective implementation of DORA, these firms can be expected to continue to use spreadsheets as their only monitoring tool. And as a result, they'll adopt a resource-intensive and inefficient approach to monitoring DORA. Again, we do have to recognise that spreadsheets have an important role to play in many financial institutions, but this isn't an excuse to use them in the DORA arena. Business is no longer linear. Organisations' ecosystems have become increasingly complex. As digitalisation has increased, so have attempts by cyber criminals and other bad actors to access firms' data. In addition, a multifaceted approach is now needed for regulatory compliance. And that approach will enable firms to comply both with the European regulation, but also global regulation. Those who continue to believe that spreadsheets are an effective means of monitoring not only DORA, but also other regulatory compliance requirements simply fail to understand the complexity of capturing the information that you need from multiple sources and maintaining it on a spreadsheet. The key consequences of relying on spreadsheets are the risk of error, and that could either be in the form of data entry, formula creation, manual updates, and even I've seen small mistakes lead to significant tracking and reporting incompleteness. Spreadsheets also, if you're using spreadsheets, there's a lack of scalability. As your firm grows, it becomes more complex, and the volume of data that you will need to be managed to demonstrate DORA compliance and ensure DORA compliance will increase. And spreadsheets simply can't handle these large data sets effectively. I'm sure lots of us will have had those problems using spreadsheets in the past, where it simply can't deal with the volume of data. And also, as I've said before, using spreadsheets is inefficient and creates monitoring gaps. One of the risks that firms using spreadsheets run as well is one that does worry me very significantly, and it's the security consequences. Spreadsheets are significantly less secure than dedicated compliance monitoring systems. You can't easily share, copy or alter the data, and so you're just creating, you're setting yourselves up to fail. We've also seen in the past this possibility that data just languishes in silos. We've seen it in the past with regard to things like conduct risk and operational risk. Spreadsheets don't integrate well into an IT infrastructure, so these data silos make it very difficult to get a holistic view both of operational risks and your DORA compliance. And finally, the risk you're running by running spreadsheets is one of inadequate reporting. It's very difficult to generate comprehensive compliance reporting and defensible audit trails when using spreadsheets to track change over time. So I think that the phrase I would like to leave people with is the one that I've mentioned before, is that absence of evidence is evidence of absence. And that's a risk that you run if you're using spreadsheets. Thank you, Nicola.
That's great. Thank you, Andrew. And then I'm going to move on because we're chuntering through these now. So myth number 5, I'm going to turn to Antony. So myth number 5 is we have all the data we need to conduct DORA scenario testing.
Yeah, this is a big area of concern, and I've been nodding furiously in the background here to all of the panel's points. and specifically around scenario testing. I shared a panel a few weeks ago at a operational resilience conference with the UK regulator, the FCA. The FCA, just to provide some context, picked up very much on the concept and the requirement for testing for scenarios, and that seems to be a very big area of concern for that regulator, which presumably will be a shared concern with the EU regulators as well. And the advice given was very much, testing is key for scenarios, looking at boundaries, looking at failures, looking at communications. And the regulator also established the fact that critical third parties are now at an increased level of risk for businesses. And I was talking to a fairly large global investment management company yesterday. They actually have more suppliers than they have employees now. 2,500 suppliers being reviewed for risk assessments for compliance versus 1,800 employees. So this supply chain is now significant, and it's a huge elephant in the room, unfortunately, because people don't know how to feed the elephant, water the elephant, tame the elephant, manage the elephant. Even if they look at how do they bite-size it up into chunks to take that on, it's very difficult to get the information that's needed from the suppliers to do scenario testing. And that's one of the reasons why GEOM has gone out and sourced and partnered with specialist data providers that specifically focus on finding the information, the data necessary for suppliers, whether they are technology suppliers, financial services providers, whether they're printing credit cards or printing invoices, that allow us to monitor, track, and embed that data from a 24/7 perspective into the GEOM platform. And they're looking at areas such as the health of the company financially. Is the company being cyber attacked? Has the company got an increased number of complaints within the financial ombudsman scheme here in the UK? Has the company got any key stakeholder issues from a personnel perspective? Is the company demonstrating a huge churn or an increased level of churn of key staff, for example, compliance or risk officers, joining and leaving an organisation within 3 months? Is that an indicator of a risk that we haven't seen or thought of or had the data of before? And all the way through to, are we seeing conflicts of interest? Why is the chief executive officer also the chief compliance officer of this firm that we're reliant upon? And talking to a chief risk officer a few weeks ago for a very large bank, he said, if a cloud service provider goes down, let's say it's AWS, which has quite a large footprint in Europe, then I'm less worried about that because that will affect the whole of the industry. The thing that worries me the most is the supplier that has somebody writing a piece of code that I have no visibility of. That code is impacting my business at some point, maybe potentially. And that's the thing that worries me the most. And this is the reason why the regulators are so focused on this topic of scenario testing. And in the context of third-party suppliers, this has to be not just a tick box exercise, but it has to be an ongoing operational resilience mindset. It has to be an ongoing 24/7 in the background, real-time event. And the advice that they also gave is that the rules that the FCA are currently working on here in the UK, they're very much being introduced and aligned to the EU DORA rules and also to US North American rules that are being established. So the 3 bits of advice that the regulator gave at the end of the panel were: test your testing, never give up on testing, think out of the box of how you're testing, focus on your third-party risks more than you are now, and make operational resilience a permanent mindset across your organisation. So the firms that we're partnering with right now that provide this specialist data, that can be used for scenario testing. It can give you real-time current information on companies. It's not synthetic and it's not archived or backward-looking data. So even things like, has the company registered their company accounts on time? Have they got a history of delayed registration of company accounts? How much cash has that firm got in the bank? How long is their runway for survival? If they're a fintech, which lots of firms have now embedded as part of an organization's digital experience to their customers, these fintechs are privately owned traditionally. They don't have to provide detailed financial results by law. So how do we know how much money they've got in the bank? And investment is drying up, and it's harder for these firms to raise investment. So what's our insolvency clause? How do we test the insolvency clauses for all of our suppliers? How do we test the offboarding and the onboarding of new suppliers? And these are now part of the DORA regulation, that an FSI is responsible and accountable for managing and attesting and certifying their suppliers, but also running annual tests to show how they can offboard a supplier that isn't compliant and how they can onboard suppliers that are. And to complement those specialist data providers that we're working with, we've also built a Magpie Gen AI module, multi-agent prompt engine. So the Magpie Gen AI module, which we can provide, also can review automatically contracts, policies, documentation from suppliers, and it can highlight non-compliance across those documents automatically. And Andrew referred to lots of resources and people being involved in data churning, whether it's Excel or legal people looking at contracts in PDF format. The Magpie Gen AI engine can actually automate all of that task away from a data-heavy, cost-heavy process that allow you to scenario test from a pre-onboarding, monitoring and surveillance and post-onboarding process to say, how are contracts standing up to our changes in our insolvency clauses? We now want to lift up the level of insolvency clauses to be higher, more stringent. Which suppliers, which contracts, which policies with those suppliers are impacted by that we can then triage and really then go and engage those suppliers from a scenario testing perspective to get the information that we need. And I think finally, the thing that everyone's really struggling with in this space is when we ask the suppliers the information that we need, they're not obliged, they're not contractually obligated, they're finding it very difficult to give us the information that we need. If you go back to a supplier with a test result that shows non-compliance or shows a risk that you've uncovered in the business operation that's deemed to be critical with that supplier, you can then give the supplier that evidence. So as well as automating surveys and questionnaires to supply chains from the DORA 360 platform, we can also now provide the evidence to the supplier to say, we've highlighted and found this risk in your business. We need to get the evidence back from you to satisfy not only ourselves, but the regulator to show how you are effectively addressing that issue, that risk. And so the scenario testing shouldn't be synthetic or made up or has no reason to be a trial run. It can be using actual current real live data, highlighting real current risks in supply chains, and allowing you to provide that supplier with the evidence that you've got to say, you need to respond to the scenario test that's failed. And we need to see specific answers back from questions.
Yeah, and just to mention there, just to finish up, that the tools and the capabilities that you're talking about there, Anthony, if anyone wants to learn more about those, they're available at on the website at dora360.ai. So I'm going to move on now to myth 6, which is we are ISO 27001 certified, so we are DORA compliant now. I'm going to cover this off. I can do this quite quickly, really, because it's kind of a drill down from what Bhavana was talking about earlier in terms of it being cybersecurity and infosec. So firms have gone to great lengths over recent years to achieve 27001 certification, which certainly validates their commitment to information security. But one of the things that Antony and I have heard numerous times over the last several months is that many firms believe that ISO 27001 makes them DORA compliant. The simple answer is it doesn't. And those who believe this myth risk being under increased scrutiny from the regulators, facing enforcement fines, other operational sanctions. But also DORA places specific emphasis on senior manager accountability. So senior managers are responsible for ensuring that complete, robust and defensible compliance practices are put into place, and their failure to do so could result in sort of personal sanctions because they have personal liability. So the reality is that DORA has operational resilience at its core, and it is a mandatory regulation. ISO is an info security standard, and it's optional. So that's a fundamental difference from the get-go between the two. So those who have 27001 certification certainly have a head start in terms of having systems and processes in place that they can build upon as new regulations come to bear. And they also are more likely to have a more robust risk management mindset or risk mindset throughout the organization. But DORA requires different processes and different controls and practices. And so ISO still falls short in that respect. So firms who believe this myth are exposed in four ways. The first one being the need for continuous compliance and monitoring. So DORA requires ongoing business continuity management, whereas ISO has no requirement for ongoing monitoring of business continuity. And certainly, where ISO has periodic reviews in this respect, DORA requires continuous management. So there's quite a difference there. The second thing is that regular testing and updates are required. So ISO requires vulnerability testing versus the very stringent threat-led penetration testing that is required by DORA. So DORA's penetration testing needs to take place at least every 3 years or every year for ICT systems and tools. So most firms are going to find that their current practices fall short. Number three, but probably one of the most important, is third-party risk management, which others on the panel have discussed. So DORA has an unprecedented requirement to analyse and evidence the compliance of third parties. And this is something that ICT service providers haven't been used to doing either themselves historically. It's relatively uncharted territory. And financial institutions need exit strategies when things go wrong. Whereas 27001 is more of an internally focused info security standard. So there is no definition or requirement for assessment of third parties. And last but not least, incident management. So DORA has incident management requirements that are of a scale and timescale that is very demanding, very difficult to meet. The initial notification period is within 4 hours of classification and no more than 24 hours of discovery. Intermediate reports within 72 hours, and the final report within 1 month of the cause being identified. So in comparison, ISO 27001 has notification procedures, but these are inadequate for DORA. Yet again, that's an example of where being ISO 27001 certified will not make you DORA compliant. So in summary, having the ISO standard certainly puts you in a better position than if you haven't got it, but it's going to be inadequate. And what firms need to do now is look at building on the processes that they have in place already to adapt them to the DORA requirements. They need to evolve what may be a relatively siloed risk management mindset into a much broader operational resilience mindset throughout the organization. And I think the most important thing is to leverage technology. So the technologies Antony just talked about, so Gen AI, smart automations, to deliver the regulatory intelligence and the level of continuous monitoring that is required to achieve DORA compliance. So firms have gone to great lengths over recent years to achieve 27001 certification, which certainly validates their commitment to information security. So I'm going to move very swiftly on to Bhavana because we're running short on time at this point. But myth number 7, ICT service providers not named on the DORA critical suppliers list don't have to comply.
Coming to myth 7, the myth being ICT service providers not named on the regulator's DORA critical suppliers list don't have to comply. This could not be further from the truth. So although DORA was primarily designed for financial institutions, its impact also extends to ICT service providers supporting the financial sector. DORA regulations apply directly to ICT service providers under regulatory supervision when they are classified as critical ICT third-party service providers. Now, who is a critical third-party service provider? This is as defined and laid out in the DORA Article 31, Paragraph 2. And what does the criteria include? It includes the extent and nature of the financial sector's reliance on the ICT third-party service provider, the importance of the services provided, the potential impact of any disruption, and also the interconnectedness of these services with other critical operations. So the designation of this critical status is issued by the European supervisory authorities, specifically the European Banking Authority, the European Insurance and Occupational Pensions Authority, and the European Securities and Markets Authority. And all this through a joint committee based on recommendations from the Oversight Forum. So many ICT providers believe this myth that the direct impact of the regulation affects only firms officially designated as critical ICT third-party service providers. Typically, and that too, this is the largest ICT service providers, and may not extend to the smaller firms who are not listed on the designated critical list. Many also hold the misguided belief that only the ICT third-party service providers based in Europe have to comply with DORA, when it is the location of the financial services client that determines their regulatory obligations. So the risk of believing this myth is organizations have a narrow view and they will overlook the broader indirect implication of DORA, which will also impose significant obligations on these providers because they are supporting those specific financial entities. As a result, some of the providers may not fully appreciate the extent of their responsibilities under this regulation. And they may end up losing contracts with financial entities. They may fall out of compliance with regulatory requirements and incur some financial penalties. They may get replaced by competitors who now meet the DORA standards when others don't. And they may also experience a reduction in the market share. So these outcomes are not desirable, and hence every service provider needs to become vigilant. So if you look at the reality is whether an ICT service provider is on the officially designated critical list or not, any third party that is critical to a financial entity's operational resilience must be assessed and monitored to ensure operational resilience. So the DORA regulation, is getting applied both directly and indirectly. And the extent of these obligations will be defined by the financial entity's internal policies for enforcing the terms. It's possible that DORA's financial entities may only contract with ICT third-party service providers who adhere to the specified standards. So existing contracts may need to be amended or supplemented with the clauses required by DORA. So these additional obligations could lead to increased costs for the ICT service providers, depending on how they are regulated in the agreement. So ICT service providers should evaluate how DORA will affect their operations without delay and prepare accordingly. This involves understanding the specific requirements of DORA, such as adherence to stringent information security standards, assessing the compliance status of critical third parties, and potentially making changes to contractual agreements. Providers should expect to face heightened scrutiny and more frequent audits from financial entities, which will be assessing compliance with the DORA regulations. Preparing in advance will help mitigate risk and adapt to new compliance requirements and manage any potential increase in operational costs or administrative burdens associated with these heightened scrutiny measures. It will also help these providers create some competitive advantage.